Looking to invest while you're in your 30s? Wondering how to appropriately meet your current needs and your long-term needs? Want to balance your returns with safe, growing, market-beating dividend income? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. I've been investing for more than 10 years now. I started investing in my late 20s and I'm now in my late 30s, so I have firsthand experience with how investing changes as you grow older. Now, I'm a dividend growth investor. I stick only to high quality stocks that pay safe, growing dividends. Why? Because they're some of the best stocks in the world. There's a chain reaction at play here. It's a virtuous circle of selling what the world wants, producing ever more profit, and rewarding shareholders with ever-rising dividends. But the specific stocks that are best at one age might not necessarily be the best stocks at another age. That's because of changes in things like one's need for income, their risk tolerance, and their time horizon. As an investor in my 30s, I think I'm especially qualified to talk about dividend growth stocks that could be particularly compelling for investors in the same age range. When you're in your 30s, it's very important to find that balance between yield and growth. And quality remains super vital because you have decades still ahead of you. Whenever I buy a stock, I'm thinking about both the Jason of 2022 and the Jason of 2052. I desire market-beating income for today's needs, but I also seek growth in order to make sure that my wealth and purchasing power continue to increase over time. Today, I want to tell you about 3 dividend growth stocks to consider buying if you're in your 30s. Ready? Let's dig in. The first dividend growth stock I want to highlight today is Aflac Incorporated, stock ticker AFL. Aflac is a supplemental insurance company. Want to get rich over the long run? Then it's hard to ignore insurance. Insurance has long been one of Warren Buffett's favorite business models, and he used it as a platform to build much of his $100 billion fortune. It's also one of my favorite business models. You've heard of making money from other people's money, right? Well, insurance has perfected this idea. That's right, they collect premiums up front, and because there's typically a long delay between collecting said premiums and then paying out on claims, they're able to invest that premium income. That turns into what's called a float, a collective source of low-cost, low-risk capital that can earn a significant amount of money. In fact, a lot of insurance companies actually make more money from the float than they do by selling insurance. And this 1-2 punch can lead to tremendous results over the long run. Consider Aflac as a great example. By combining a solid supplemental insurance business model with their $100+ billion global investment portfolio, Aflac has turned in some great numbers. The stock has compounded at over 14% per year over the last decade. That kind of compound annual growth rate doubles your money every 5 years. It's not just that though. Aflac is a dividend growth machine. This stock offers a great balance between income for today and the growth of that income for the tomorrows to come. The stock yields 2.7%, which is about twice as high as the broader market's yield. And this is a vaunted dividend aristocrat, which is a special status reserved for stocks with 25 or more consecutive years of dividend increases. Aflac has increased its dividend for 40 consecutive years with a 10-year dividend growth rate of 7.9%. Inflation is high, but Aflac's dividend growth has been even higher. Keep in mind too that their most recent dividend increase came in at over 21%. And with a payout ratio of just 25%, the dividend has plenty of room to head higher and higher for years to come. Despite great long-term performance, the stock is perennially cheap. I've never seen this stock look expensive, but because the business continues to put up great numbers, the stock grinds higher anyway. That's kind of the best of both worlds. You get the great performance, but you also get consistent ongoing entry points to buy. And that's on top of the yield and growth. With a price to earnings ratio of 9.2, we're talking about an earnings multiple that's about half that of the broader markets. And it's not even as high as the stock's own 5-year average price to earnings ratio of 9.7, which in and of itself is quite low. Like I said, perennially cheap. This Dividend Aristocrat offers balance across the board for a 30-something investor. Next up, I want to tell you about Johnson & Johnson, stock ticker J&J. Johnson & Johnson is a global healthcare conglomerate. You want another great business model? This is it. Think about it. What's happening in the world? Humanity is expanding its population, so there's more people. We also know that the average life expectancy keeps rising worldwide, so now it's more people living even longer. And then there's the fact that, on average, people are becoming wealthier. What do you think a larger pool of older and wealthier people will demand? Quality healthcare, of course. It's a no-brainer. This is secular growth. And if you're in your 30s thinking about investing for the next few decades, that is what you want. But it isn't all just the birds in the bush. It's not all future growth. Johnson & Johnson also gives you a bird in the hand. This company has both balance and excellence across the board. There's almost nothing to fault with Johnson & Johnson. Everything is either really good or great. The stock has been a very good performer, compound annual growth rate of better than 13% over the last decade, which has been powered by very good business performance. No problems there. Oh, and how about that balance sheet? It's one of only 2 companies in the world with a AAA credit rating from Standard & Poor's. And then there's the fact that the business model is balanced across healthcare with exposure to medical devices, pharmaceuticals, and even consumer products. It's the same story with the dividend. We get more balance and excellence. First, the excellence. We've got another Dividend Aristocrat on our hands. Actually, this is a Dividend Aristocrat more than twice over, with 59 consecutive years of dividend increases under its belt. Now, balance. You get a solid market-beating yield of 2.5%, and you balance that with a solid, consistent 10-year dividend growth rate of 6.4%, a level that has historically, up until the last year, easily beaten inflation. So it's a good amount of income today and a good amount of growth for the future. Then there's the balanced payout ratio. The dividend will only suck up 40.3% of the company's adjusted earnings per share for this coming fiscal year based on forward guidance at the midpoint. That balances returning cash to shareholders with retaining profit for internal growth. And even the valuation is balanced. Let's be clear, this is a high-quality Dividend Aristocrat. You shouldn't expect it to be priced like a low-quality money loser. All the same though, the valuation is not at all egregious right now. Based on that aforementioned guidance, the forward price-to-earnings ratio is only 16.4. Bargain basement territory? No, but definitely not expensive. It's reasonable. There's also a potential catalyst to unlock further value here though, with Johnson & Johnson set to spin off their consumer health division sometime next year. In my view, this is a perfect stock to consider for 30-something dividend growth investors. Last but not least, let's talk about T. Rowe Price Group Inc., stock ticker TROW. T. Rowe Price is a global investment management firm. Insurance is a great long-term bet, so is healthcare. Well, I'd argue that global asset management is yet another. After all, a big part of the global expansion and wealth that I noted earlier is, of course, due to the rising prices and values of global assets. T. Rowe Price has huge exposure to this rising tide lifting all boats because of its $1.6 trillion in assets under management. Do you believe that companies will continue to sell more products and or services to more people at higher prices? Do you believe that the world will continue to increase its global population, technology prowess, efficiency, and overall capital? In my opinion, it'd be silly to think otherwise. And so it's not difficult to draw a straight line from all of that to T. Rowe Price making more money through the fees it charges on a rising base of assets under management. This is a company that is very high quality across the board. The balance sheet is a great example. The company has no long-term debt. I repeat, no long-term debt. And all it's done over the last decade is consistently grow its revenue and earnings per share. That consistent growth in the business has led to consistent growth in the stock. The stock's compound annual growth rate is almost 12% over the last decade, and that's even factoring in the recent weakness that's come with the broader market's recent volatility. Their dividend track record is just more evidence of T. Rowe Price's high quality. We've got another dividend aristocrat on our hands, perfect for youngish investors who still have decades ahead of them to think about and plan for and want that kind of current and long-term security. T. Rowe Price has increased its dividend for 36 consecutive years, and the 10-year dividend growth rate is 13.3%, which is twice as high as the unusually high recent rate of inflation. Along with that double-digit long-term dividend growth comes a market-beating yield of 3.6%. This dividend is protected by not only that debt-free balance sheet, but also a low payout ratio of 36.6%. You get quality, growth, yield, and even value here. After a 40% drop from its 52-week high, you now get it all. The price-earnings ratio of 10.3 is incredibly low for a company of this quality, and it's well off of its own 5-year average of 15.4. Now, the company has been printing some great numbers over the last few years. The recent volatility will bring down assets under management, fees, and earnings per share. So this price-earnings ratio is probably a bit higher than it appears to be. Still, the stock is priced like it was before the pandemic hit. So we've effectively already zeroed out all of the gains in the business over the last 2 years. This debt-free dividend aristocrat is a compelling idea for dividend growth investors in their 30s looking for a high-quality business that can give them a good amount of secure dividend income for their needs today, as well as growth for their needs in the years ahead. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 3 dividend growth stocks to consider if you're in your 30s. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.